Welcome. I'm excited today to get to introduce the multi-asset income new frontier style for everybody and have an interesting discussion about what income means, why people should be interested in investing in income, what the challenges are. Joy will bring that up. And then I'll talk a little bit more about our solutions, and we can hopefully have a lively question and answer session. So there have already been quite a few questions coming in. And so we'll answer those at the end, but we hope that people will have more questions as they come along. I think I'm also supposed to remember to say that this is CE credits, so make sure that you send in your information for that. And also that there was another thing I was supposed to remember, but we'll probably figure it out along the way. So by the way, I'm Robert Michaud, the Chief Investment Officer at New Frontier, and we'll be joined by Joy Zhang, our Senior Research Analyst here. So let me get started talking about why we're here. And this is, I think, where we want to start is, before you think about how our multi-asset income solution works, what is in it, what it does, what the performance is, before you even think of any of those questions, you should really be thinking about why are you investing, what is the goal of your clients, and then how does that fit into the portfolio. I think broadly speaking, there are two main investment objectives that most people have here, and that is that you're investing to accumulate wealth, or you're investing for income. Sometimes when I hear about investing for income, I think back on some high school Victorian novels, or perhaps they're not actually Victorian novels, they might be some other period in English history, but where they talk about Mr. Darcy with his 10,000 pounds a year, and nowhere in the book does it say how much wealth Mr. Darcy actually has. It talks about how much income he has, and that's his status, and that's what's really important. And so while we've certainly progressed beyond that economic era, I think it is important to think about, well, are your clients, are they investing for retirement? And in retirement, what are their needs? Are they looking for a consistent income? Are they looking to preserve the wealth? Are they looking to just make sure they have some reliable nominal amount, or are they looking for something that meets their lifestyle needs? And these will determine their types of appropriate investment products for them. So as far as meeting your investment goals, normally there's just a few unpleasant options about working longer, saving more, spending less. The option that sometimes seems appealing to investors is to take more risk. Now, take more risk is not a free option, right? It means that there's a greater chance that you will be sorely disappointed, or at least a little bit disappointed, when you're taking more risk. So the option that I think it should really focus on first is make sure that the investment product that they're in is really the most efficient way for them to meet their goals. And so that means understanding them. And so just some potential goals I think, to bring up again, inflation protection and meeting a standard of living which could be rising over time. And how important is it to be able to change your portfolio? So, for the income need, lifestyle risk, I want to introduce this concept, is meeting the inflation-adjusted standard of living costs. And standard of living rises over time, right? As technology progresses, as incomes grow, as economies go up and down, but mostly up over time, the standard of living rises. So that's more than just an inflation adjustment. And so the problem for investing with that is that bonds don't grow. Bonds have their fixed value, and hopefully you will get all the coupon payments and your principal back, but bonds don't grow. And stocks don't have sufficient income. Right now it's around 1.6% for the S&P 500, which is not enough for most people's income needs. So somewhere in there is what most people are really looking for. So to start off, this is the last 65 years. So somebody who's retiring now, this is their lifetime inflation changes, so change in CPI. And so you see that inflation has gone up a couple 100% over their lifetime. Makes sense. But do they need 200 whatever percent more now? I would argue that they need significantly more than that. And this is per average person's income, so per capita income. And so this goes up faster than inflation. And so if you really want to be able to meet your lifestyle needs, then the only source of return for that usually is something like an equity. Now, equities are volatile and have their issues as an income source, but what I would like to look at from this picture is if you're thinking about, well, how much equities might you need to be able to make this basic goal of keeping up with per capita income? It's something like roughly a 40% or maybe a little more than that equities are needed just to be able to maintain a standard of living in a portfolio. Now, when you think about what other types of solutions there are, I always want to make sure that you remember that something like annuities, they're not magical, right? They can go out to the fixed income market, they can buy the securities out there like everyone else. And sure, an insurance company has ways of wrapping them all up in a product and spreading out risk. But as a financial product, they are simply underneath it, mostly just bonds. And so from that perspective, the advantage is they can give you a really clear lifetime income, but they're expensive or irreversible. And some of these customizations that seem appealing, you have to remember that some annuity providers maybe charge more than they should, but even the ones that really don't really try to give you the most honest annuity that they can, when they're really complex, when they solve for all these contingencies, then those are hard problems to solve, there are risks involved, and there has to be a profit cushion involved so that the insurance companies don't go out of business for issuing annuities that are too cheap. So that might leave you with something like a bond ladder to give you really consistent income. But bond ladders are also subject to inflation risk. And both of these things have to do with interest rates today and the risk to interest rates. An annuity has the duration something like a long-term bond. And so we all know what happened to long-term bonds last year with the changes in interest rates. So the annuities might look like they have no risk from one perspective, but the value of an annuity over the last year probably fell by close to 30% for many people. So that leaves us with stocks. Stocks are great. Stocks certainly grow, and there's nothing at all wrong with somebody who's willing to take the risk and sell off some of their multi-asset portfolio, which includes stocks, to pay for income in retirement. But there is no clear rule for what the right amount of income to take from another portfolio. We've heard of 4% rules and debates around that. But the truth is that there's always going to be some risk unless they're needlessly conservative in how they withdraw from a portfolio. So selfies are the next thing that I kind of like to talk about. And these are a product that seem like they should be the perfect risk-free, bottom of the efficient frontier if you're concerned about meeting a rising standard of living type of asset. This is something that Nobel Prize winner Bob Merton talks about at great length. He's very persuasive for me, but he has not yet persuaded the Treasury to issue these things. So that is a big problem because they don't exist, so you can't invest in them. So I like to think of multi-asset income as a good compromise of needs here. And I'll just sort of plot these things that I just talked about we like optimization around here. We think of maybe too many things as efficient frontiers, but you can also think about, this is not a perfectly quantifiable efficient frontier, but a sort of stylized efficient frontier where the good is what type of lifestyle do you think you'll be able to live with this investment style? The bad, the risk, is the risk of missing this goal. And so I put Bob Merton's selfies there right at the minimum variance efficient point of the frontier. Unfortunately, they don't exist, which might make them less efficient. But I think of multi-asset income as sort of a sweet spot of what, if you are really thinking about meeting lifestyle goals and the risks associated with that, and having a portfolio that can provide income for that goal, then that's what multi-asset income from New Frontier is designed for. So it has stocks for growth, fixed income for reliability, and dividends help you determine a sustainable consumption level, right? So this is all about sustainable income that you can get from a portfolio. So with that, I would like to have a poll, and then Joy can talk about some of the challenges of building these income strategies. So the poll is, what percentage of your clients have income as part of their investment objectives? So since today's talk is about income, we hope that this is an informative poll for you. So talking while staring at a blank screen is nothing I was ever trained for. But hopefully everybody has, okay, so this is nice. It's a classic bell curve, a little bit more, maybe a little more uniform. But so this is, I guess you're all glad you're here. Everybody is interested in income investing. So with that, I will leave it to Joy, and we will be inspired to keep talking about income.
Great, thank you, Robert. And thanks again, everyone, for taking your time to join us. I'm Joy Jen. Robert has very nicely laid out the context of what is income investing and what is the objective of income investing, which is about current income and capital growth over time. But building income portfolio to provide such a goal, right, to sustain such a goal is not an easy thing as you might think. And to understand the challenge, I think the starting point for us is to understand the inputs that go into the process. So here I'm breaking down total return into price return and income return for several major bond indices and several broad equity indices. And this is really to give you a very intuitive notion of what different sources of return are. And from the upper table, we can see that income provides the majority of total return for bonds. High yield is a very typical example here with very high income, well, a little bit price depreciation, but still overall total, positive total return over time. Equities on the other side have their majority of total return coming from price return, price appreciation. As you can see, US small cap growth is another typical example, right? The price return makes up the majority of total return. So as Robert also mentioned, right, the broad equity markets don't have much income. So we typically have to go into high yielding corners for high dividends. And in terms of risk, the risk of price return makes up the majority of total risk for both bonds and equities. So now we know bond income, equity dividends, and price appreciation as different sources of return. So how should we think of them differently when we construct portfolios? Then let's take a look at an example here. So in the chart, I have investment grade corporate bond, LQD, and US high dividend ETF, DVY, with their trailing 12-month dividend yield going back to 2004. So in the chart, you will see that IG corporate bond has relatively less volatile dividend yield than DVY, the equity. And for most of the time, they are higher. And if I plot high yield here, the comparison will be more obvious. Over the time, high yield provide 6 to 8% yield. So typically, bonds are better at providing income, current income. And right now, we're looking at two ETFs with similar dividend yield of 3.5%. This is trailing dividend yield, of course. And the question is, how do we think of this 3.5% yield when we construct portfolios? So instead of dividend yield, if we look at the annual dividend payments in dollars for the same funds for the same time period, going back to 2004, and please note that I normalize those annual dividends to start at $1. I hope it's not too surprising for you that equity dividends have grown over time to $2.2 at the end of 2022, while bond income has not. And I think this is a very nice thing about equity dividends, right? In this environment, when bond yields are rising up a lot, people may ask, why do I still need equity dividends in my portfolios? And here's the answer. Because equity dividends have the potential to grow over time because capital appreciates. And with this similar dividend yield, if you have the stock price double, the dividends you receive double as well. And bonds, as we said earlier, they're better at providing current income, but they don't appreciate over time. So clearly, multi-asset allocation is the right choice for people who want consistent income. But the question remains that when two or multiple asset class provide a similar dividend yield, how should you relatively value them? Right? How should you balance the current income and potential future capital appreciation? And I believe this is where our optimization, our objective can provide a value here. And then the other challenge about building income portfolio is about risk, typically fixed income risk. So it's intuitive that when a bond has higher income, that means that it has higher risk, either duration risk or credit risk or both. And credit risk is different from duration risk in the way that it reflects the risk of default. When a bond defaults, you lose yields, you lose capital, right? So when you see higher credit spreads coming from high yield, coming from bank loans, how much of return potential, income potential we can reasonably assume, and how much additional risk you have to model into the process in order to capture the risk components that are very essential when building the estimation and optimization process for income portfolios. Because the risk of that is if you only focus on income, right? Only focus on high yield without looking at the total risk of the portfolio, you end up with high concentrations in those extremely risky bonds that leading a portfolio to a much greater risk than desired. And the other risk about constructing portfolio is about asset selection. It's not only about stocks and bonds, but there are other yield opportunities coming from alternative. MLP is a very interesting example because they're a high yielding asset class. Currently, the yield is about 7 to 8%. And they provide, the MLP ETF is a portfolio of MLPs that provide exposure to energy infrastructure. And here I'm showing you the example, right? The experience of holding MLP ETF for 10 years until the end of 2022. And here's what happened. In the beginning, you will receive very nice quarterly dividends, about $5.5 per share. But over time, the dividends received decrease and actually dropped in half at the end of the period. And at the same time, you experience severe price depreciation, price drop as well, of more than 50% at the end of period. So really together, you lost value. Your investment lost more than $200 if you held 100 shares of MLP ETF. And that's why MLP ultimately is not a desirable asset for multi-asset income portfolios, given that you both want income and capital growth over time to sustain this income objective. And it's very different from high yield, as we mentioned earlier, but high yield, even though they might depreciate over time, they still have positive total return to support your goal. So a well-informed asset selection process to pick the right asset to provide not only current income, but also sustainable income is extremely important when it comes to portfolio construction. And then Robert will address those challenges in the later section. And before I hand it back to Robert, here comes the second poll, I believe. So what are your goals for an income generating investment solution? Fixed distribution amount, reliable long-term cash flow, wealth preservation and growth, and easy to explain to clients. So we'll give 10 seconds to answer the questions. Okay, so more than 71% of advisors believe that they would like to have reliable long-term cash flow from the solution. That's great. That's what we think, that's the objective of the income portfolios. Yeah, so with that, I'm going to have Robert back to talk about new frontier solutions.
All right, thank you, Joy. So now that we know what we're trying to do here, and now that we know some of the challenges that are associated with investing for income in terms of the particular asset classes, then how do you build this solution by putting it together? So as always, you need a philosophy. You need an overarching theme and direction for how you think about investments. And so how we always think about investments is we want to take the institutional practice, try to understand the risk and return trade-offs and the goal of why we're investing, and then have a long-term optimal, but also in the immediate term, sensible portfolio solution for that. And that involves bringing together economic theory, market information, and other data from both history and present, and to get the best understanding of risk and return and what the market opportunities are now. So to show you the range of portfolio solutions that we have, we have the standard portfolios, but today we are talking about multi-asset income portfolios. And I want to point out that there is no conservative and no very aggressive multi-asset income portfolios. We have three portfolios that we consider go from the conservative end of the spectrum to the more aggressive end of the spectrum of this investment objective. And remember, at the beginning, I made a rough estimate that you need at least 40% stocks, roughly, to be able to meet this goal of being able to have your income increase enough over time so that it meets up with your lifestyle goals. Now, that also means that fixed income and other asset classes have a place there as well for providing the actual income, because dividends aren't necessarily sufficient on their own. So when you see the 40-60 and 60-40 and 75-25 here, though, that's really talking about their equivalent risk targets for a more conventional type of multi-asset portfolio. So in our investment process, we're the same investment committee, we have the same philosophy, and potentially we could be investing in many of the same ETFs, and we're of course always optimizing and rebalancing. So what's really different here? And so what's really different here is the investment objective. So we had to quantify an investment objective that we really thought was appropriate for income-seeking investors. And of course, as Joy brought up, there are different ETFs there as well. So after we have chosen the ETFs and thought about a sensible risk and return, done all of this important screening and thoughtful work on identifying, well, what's the sustainability of the income versus not, and what asset classes are appropriate versus not, then we can finally optimize this portfolio to give you a whole portfolio that's meant for a single goal. So taking many different ETFs, over 20 different ETFs, to give you the single goal of having one portfolio that behaves for providing reasonable income for you. And as with everything we do here, of course, we had this foundational idea that we thought was so important that we had to make New Frontier and name it after our new efficient frontier that we've created, for how do you construct portfolios well. And so to remind you, the way we do this is we understand that the future is uncertain. And so that what you really need to do is you need to think about all the ways that you could be making mistakes in one direction or another, ways that the future might behave differently from the past. And so we literally simulate thousands of scenarios, compute optimal portfolios in each one, and then invest in the portfolio that is the most optimal, the best diversified, given all of the future uncertainty and all of the things that you know. So this gives you a very different solution than what some other multi-asset portfolios are, right? So the whole portfolio is designed for the trade-off between meeting your goals and the risks of those. And I want to show you what the MA current ETFs are in here. Joy brought up some of this. There are some interesting fixed income types of investments. They are meant to span the spectrum of credit and duration. You notice that there are a lot of ETFs that really are focused on equity dividends, so dividend tilted equity funds. And we have to, that's a very hard problem that Joy did not have time to get in with, but because just think about, okay, I want roughly the exposure of the S&P 500. Do you have any idea how many large cap US dividend funds there are and how many different ways that they're weighted? And the performance dispersion can be shockingly large. It was as much as 10% in 2022 between these different funds. So picking the right one, understanding its characteristics, making sure that the yields you see here are the yields that you expect to get are important. And so these are some of the ETFs that we invest in. And so for the difference between our portfolio and what a traditional portfolio might look like is either traditional portfolios tend to be either focused on just return or just income. And so when you hear a multi-asset income portfolio, many of them are really optimized, if they are optimized at all, just for the income in the portfolio. And we think it's quite important to not just think about the income, but think about the sustainability and growth of the income as well. These portfolios often lead to high concentrations, and we think diversification is really important. And also there's sometimes just ad hoc rules. Not everybody has the optimization stamina that we have here. And so there are often just sort of ad hoc substitutions. The most common one is I think of is putting high yield in a multi-asset income portfolio or putting just municipal bonds in a tax-sensitive portfolio and calling it a day. But there is a sophisticated optimization that you can always do better. And really, if you can do better, this is one of those times where I think we really have a responsibility as an industry to do better, because there's no free lunches with risks, but there is, if you can build a better portfolio, this is something that can add value to your clients. And to show you what building a better portfolio can look like, here's an example that you can visualize. It's just a stylized example, but on the left, we ran an optimization with a traditional objective of income only. And so these are both targeting 5% volatility, 8% standard deviation. So on the left, it uses up most of its 8% standard deviation to maximize the yield, and it has a very high yield indeed that it is achieved with pretty much just high yield bonds and a couple others. For the same risk level, the portfolio that we've been talking about today would produce something that's quite different. And so you can see that there are far more assets that are actually invested in. On the right, you can see that it's much more diversified, that it has many different types of asset classes, that it has international and US exposure and everything, a range of duration and credit risk, right? And that's very much by design, but it's also how optimization works. The other thing, this of course won't have as much yield as investing almost everything in the highest yielding asset class, but I would make a strong case that this is a much better portfolio, and certainly more like a portfolio that I would want to invest in, and I would want people that I cared about to invest in on the right. So you're sacrificing some yield, but instead of expecting your yield to go down every year by 1.8% with depreciation, like Joy showed you with MLPs, that happens with other asset classes as well, you have a portfolio that's expected to have a modest appreciation so that your income is likely to go up a little bit every year. So to give a slightly more real world example, the last part that I haven't talked about is that, of course, we have to stay on top of the portfolio and rebalance the portfolio. And so this is with multi-asset income, the income environment is changing pretty dramatically, pretty frequently. And so we are not active managers, but we must actively pay attention and manage the portfolios. And so the portfolio was rebalanced actually just 1 week ago today. Previously, it was rebalanced about 3 months before that. And what had happened over the last 3 months that made us determine that we need to rebalance. So the way our rebalancing rules go is that we look at the portfolios. We're comparing two things. We're comparing how much did the positions that our investors are currently holding change from price changes usually, versus how much has the sort of definition of an optimal portfolio changed. And then we go back to our statistical framework, simulate scenarios, and say, well, what's the likelihood across all of these future uncertainties that the clients and investors will benefit from switching to a new, more optimal portfolio today versus going through the expense of trading the portfolio. And so that's what happened last week. And some of the reasons for that is that the Fed has been doing a lot over the last few months. And notably, there's an asset class that we added, floating rate notes. These are a relatively new asset class. They were first issued by the Treasury in 2014. So this is not something we could have done when we started investing in multi-asset income more than a decade ago. But it is something that we can do now. And it's floating rate notes, if you don't know, are very much a cash-like instrument. They're issued by the Treasury, so they have no credit risk. They are as short duration as anything. They get reset every week. And they currently, for some reason, have a slight premium over the short-term rates. And so there's a ETF, TFLO, that incorporates these things that we have started investing in. Now, normally I would not like investing in cash in a portfolio. You normally consider that a drag. But right now, with the inverted yield curve and risk the way it is, it's actually a good risk-return trade-off to have some of these in your portfolio. We removed international REITs from the portfolio, and I could talk more about those if you'd like. But the basic reason was that with conditions the way they are, their dividends were not very reliable going forward, and we didn't think they fit the mandate. The rest of the portfolio had other shifts as do happen when you re-optimize a portfolio to more stable US dividends and some other changes, and the yield is currently at about 5%. So where does that leave us? I think we certainly mentioned that income investing is challenging. There are complexities. This is not something this is a relatively new science, and these are fairly modern portfolios that do take the full power of our optimization and a lot of work from the investment committee to do. We want to make sure that we're not investing in any asset classes that may not be beneficial for you, and we need to make sure that we're putting them together in a good way. And we think it's been really successful. We've actually built tools to map like the income that we've predicted the portfolio will get, how good a job did it do of actually attaining that income. And we found that it has been very successful over the years. Right? These products we've chosen to, our solution has chosen to be fairly dependent on dividends as a more preferred way of meeting this sustainable investment objective. And you might say, aren't dividends unreliable? Well, when you have a portfolio of dividends from many different asset classes with many different geographies and cap sizes and all of that, that are also from, of course, many different companies, and you aggregate this, then the errors kind of average out, and they tend to be very reliable as a whole. So that has so far worked well for these portfolios. But it keeps us busy. It requires a lot of oversight, and markets always change. So with that, I think we want to get ready for questions, and Joy is back here, and hopefully we have lots of questions.
Yes, great. And again, thanks, Robert, for your insights and comments, and thanks everyone for being with us. And we have received a lot of great questions pre-webinar and also throughout the webinar. And with Robert here, it's time for Q&A. So the first question is about current performance about our multi-asset income portfolios. So our portfolios year to date delivered positive returns about 2% across 3 risk profiles and a little ahead of the benchmark. The yields are about 5%. And I would like to note as well that last year, in a bad year like 2022, New Frontier multi-asset income portfolios held up relatively better than other total return portfolios and other income portfolios as well. So, and if you want to see the more detailed version of performance, please check our advisor portal and look at the performance sheets and let us know if you have any questions about performance. So the second question, and Robert, I think that's for you, it's about rebalance. How often do you adjust the portfolio? And I think it's important to understand how is that different from total return portfolio optimization and rebalance.
Sure. Yeah. So I just showed that we rebalanced 3 months ago, and then we rebalanced a week ago. We certainly don't rebalance every week or even every 3 months, but a lot has been changing in multi-asset income or in the income world. And so what we have found is that the multi-asset income portfolios tend to be one of our most rebalanced. I don't want to use the word active here, but they are the most dynamic of our portfolios. And so they do typically get rebalanced at least a couple times a year over the history. Traditional portfolio sometimes can go a whole year between rebalances, especially if markets are kind of behaving the way you'd expect them to behave and there haven't been any dramatic changes there. Tax-sensitive portfolios, you have to be even a little bit more careful because of taxes, obviously. But this is the interesting thing, and something that's quite different about us is we look at all of our portfolios every single day, and with a very sophisticated risk management lens that we built with our technology. And so we could potentially be trading them at any point. But I think at this point, we have a pretty good understanding of just how fast markets move and how sensitive our investment process is to that. So going forward, I think we expect these to continue to be traded a couple times a year.
That's great. The next question is about QDIA. Do you provide a QDIA for multi-asset income portfolio?
Well, as much as I like the multi-asset income portfolio for a income source, I think the standard in a qualified account for a long-term investing, and which has a very significant wealth accumulation component to it, I think like a balanced 60-40 standard global portfolio is the more common QDIA choice.
Great. And the next question is about asking about the yield opportunities. So what are the best sources of income in today's markets?
Well, we talked about floating rate notes, which because of the inverted yield curve have among the highest current yields of anything. Now, the inverted yield curve will expect that those will go down. So a year from now, we might not have floating rate notes as a major component in our portfolios, but it makes sense for now from a risk and return perspective. I don't have one favorite, and I think it's important that we shouldn't have favorites, because the point is to build a portfolio that performs well and meets your investment goals. And so I think you need a lot of different types of assets that are efficiently priced, that are and a very solid ETF that represent their asset class well. You need to understand the risks involved, like you talked about, and put these together in a portfolio.
Yeah, that makes total sense, right? As we both mentioned, right? It's building income portfolios to sustain your income goal is really about, it's a balancing act to some extent. There's a trade-off. There's not always one single best source for providing income. It's always about balancing between current income and the potential future cash flows. So yeah, that's great. And the next question is actually coming from live chat is about yields. So we mentioned current yields about 5%. What about the distribution rate?
Oh, thanks for you're the have you looked that up while I was talking? No. So the way these portfolios are set up is that investors can choose how they withdraw from the portfolios. On some platforms that you can choose that all income that comes out of the portfolio is immediately deposited into an account for your use. Or you can use it as leave it there and it'll be available on demand. It's more in the spirit of multi-asset income portfolios to really let they're designed by us so that the full income of the portfolio is something that you can safely withdraw and consume. You don't need to reinvest it. It should still, by design, keep up with these sort of sustainable living goals. That's not dramatic appreciation. You're not going to be the next billionaire top list by investing in multi-asset income if you take all your dividends away, but this is what it's designed for, to have the principal protected, rising slowly to meet your needs, but the income is usable.
Mm-hmm. Yeah, and I will add that just for clarification, when we talk about current yields, we know because the bond yields are up a lot, it's not proper to use trailing 12-month dividend yield as a proxy for bond dividend yield. So here we use SEC 30-day yield, which is reflecting more current yields change for fixed income. For equities, SEC yield and trailing 12-month dividend yield, they're not that different. So yeah, current yields of 5% reflect more recent yields change for our portfolios, so which is more up to date.
Yeah, it's definitely about the yield that we expect to get in the future, not the yield that has been in the past.
Exactly. And the next question is about interest rate change. So how do we disconnect an interest rate driven correlation between fixed income and equities in deriving income for retiree clients?
Okay, well, that's a good question. That's something that we debate a lot in the investment committee. And so whoever asked that question would probably really enjoy coming and sitting in on our investment committee meetings, because it's pretty fundamental, right? So last year, we have this long history of how risk and correlations work, and that was completely broken down last year. And so it's something that we actually, before last year, thought, okay, well, 2022 is going to be different. It's inflationary, the Fed's raising interest rates. That's going to break down some of these correlations from the past. It's going to also mean that fixed income is very volatile. We were not happy that we turned out to be right on those things, because of course these things happened in a much greater magnitude than anyone expected. So just because we thought fixed income would be twice as volatile, and turns out that it was far more risky than that. But these are not the sort of things that you can forecast or should really spend too much time forecasting. But right, as your question said, you should not just be backward looking. So last year, there was the correlation from inflation is high, the Fed's going to raise rates, higher rates hurt bonds. And of course, the Fed's whole point is to slow down the economy, risk a recession, which also hurts stocks. And so there's this very strong positive correlation. I think there's still a little bit of that, but we have certainly moved on in large part from, oh, how surprising a recession might happen, to markets are much more expecting a recession is likely to happen at some point. They don't know exactly when. And so there is, as cliched as it is, there is this priced in component of recession risk that's built into stocks, which means that stocks and bonds don't have to be as positively correlated as they were.
Mm-hmm. Yeah, that's great. And given the limit of the time we have, here's the last question. So what are you doing internationally with the portfolio?
So I think, Joy, you pointed out just how high some of the correlations have been internationally. And that would make you think, well, why aren't we very international? I mean, look at how depressed European stocks are, and some of them have still managed to pay a dividend. Well, two things here. One is that European stocks are depressed to the extent that they are because of risks associated with them, right? There's this, they're not just cheap and definitely a good deal, they're cheap for a reason. And so we have to be quite sensitive to what those risks are. And the other thing is that we're, again, thinking about future dividends. And so sometimes when international dividend yields look too good to be true, they a little bit at least are. And so these are risks that we balance off, right? But I do think that there's this maybe a higher risk premium internationally, but there's also this higher risk. So that means that you probably don't want much more risk now than you were comfortable with before here. So we have definitely international exposure for the higher yields, but it's not dramatic.
Yeah, that's perfect. Thanks, Robert. Yeah, so I think that's all for Q&A. And for the questions we don't have time to get to, we will make sure to follow up with you individually to have your questions answered. And so with that, thank you all for attending. And if you have any questions for our New Frontier portfolios, or especially multi-asset income portfolios or other portfolios, please reach out to any of our consultants at any time. And also a recorded version of this webinar will be available shortly, and we will send you an email to let you know when it's ready. So before we conclude, please take your time to take their survey at the end of the webinar. Your feedback is very valuable to us. So thank you again for joining us today. I'm Joy Jen here with Robert Michelle. Looking forward to seeing you again next time. Have a great day.
Thank you.